Organization for Islamic Financial Institutions and is a certified Sharia advisor and auditor. He advises the bank as an internal representative of the bank's Sharia Supervisory Committee and undertakes regular Sharia compliance audits into the bank's operations. He obtained an MA degree in Islamic Banking Finance and Management from Loughborough University and holds a postgraduate diploma and BA in Islamic Studies, mashallah, from leading universities in Damascus. Samir has extensive knowledge of Sharia law and Islamic commercial law and is experienced in their application in Islamic banking and finance. He combines knowledge and experience for both Sharia and economics and finance, and has delivered numerous trainings, workshops, and lectures. I'll show you a very quick clip of Al Rayyan's advert, and then I'll swap over and Samir will begin.
We all have a duty to create the world we want to live in, the world we want to share with our children. But part of choosing the right way means finding a bank that shares our values. Al Rayyan Bank is different to other banks. We're an ethical British bank that exclusively follows Sharia principles, one that cares about the world we all want to live in. Al Rayyan Bank, banking you can believe in.
Brothers and sisters, Samir.
بسم الله الرحمن الرحيم والصلاة والتسليم على سيدنا محمد وعلى آله وصحبه أجمعين. السلام عليكم ورحمة الله. Basically, as the theme of this event, sorry, can you hear me at the back? Yes. All right. As the theme of this event basically is Muslim lifestyle, halal Muslim lifestyle. There are many factors involved in the Muslim lifestyle. The halal food, halal tourism, halal education in terms of the Islamic education for our children, and the finance aspect and banking aspect. Basically, banking and finance is very important part of our life. The same way we are not allowed to eat non-halal food or non-halal meat, we cannot bank with conventional banks because they are not halal. There is basically, they are based on the interest element and other prohibited elements in Sharia. This presentation is condensed but comprehensive. We'll attempt to answer three issues: what Islamic finance is, how it works, and how basically it is different from the conventional banking system. We'll start initially with an overview of an important part of Sharia and what that represents in terms of Islamic finance, then brief historical overview in terms of where Islamic finance started and when, and how it evolved. We'll basically then look into different types of Islamic finance principles, and at the end there will be basically a session for questions and answers. As we say, Sharia compliant financial products, what does that mean? Is it just a labeling of products as being compliant with Sharia? Or there is more deeper meaning for that? Basically, any financial products provided by Islamic banks are based on the two primary principles or the two primary sources of Sharia: the Quran and the Sunnah of Prophet Muhammad sallallahu alayhi wa sallam. Those basically present the fundamentals of Sharia as a whole, and in particular the principles for Islamic finance. In Sharia there are constant rules, that those rules are fixed regardless of time or place. For example, gambling is haram, that's given. 14 years ago at the time, 1400 years ago at the time of Prophet Muhammad sallallahu alaihi wasallam, that was the rule. Nowadays, this is the rule. The same applies for interest. Riba is being prohibited, and after 100 years and many centuries, that will remain the rule. This is a constant fixed rule that cannot be changed. However, as Islam is the last divine law and is a universal religion, basically there are some techniques or equipments, instruments that Sharia provides for us in order to address issues that we may face nowadays in terms of our lifestyle, the way we live as Muslims, and how we can address those issues. That's why we have secondary sources for Sharia, like Ijma, the consensus of a qualified, or the consensus of qualified scholars when they address a new arising issue in order to reach a Sharia legal opinion about this issue. Then this will be mandatory for all Muslims to follow. And that basically takes the form in different Islamic forums, like the Islamic Fiqh Academy, the Accounting and Auditing Organization for Islamic Financial Institutions, which issues basically Sharia standards for Islamic institutions. Qiyas, which is also an analytical reasoning, where the new issue presented to the Islamic jurist is examined in terms of its rationale and reasoning. Then this will be checked against existing Sharia rulings in terms of finding the same reasoning and applying the same rule to it. And ijtihad, which is basically the scholarly effort in order to come up or reach a Sharia legal opinion. Those are supporting instruments for the constant Sharia rules presented in the Quran and the Sunnah. Any legal opinion or Islamic legal opinion comes from those flexible rules, shouldn't contradict the primary sources or what we call it the constant Sharia rules in any way. So from those sources of Sharia, then scholars divided the fiqh or the Islamic jurisprudence into fiqh al-mu'amalat, Islamic financial transactions, and fiqh al-ibadat, the fiqh of worship. And the whole concept of Islamic finance, Islamic financial transactions, basically sits within fiqh al-mu'amalat, Islamic financial transactions, or the Islamic commercial law. So, where the concept of Islamic finance has started, this is not a new concept. Islamic finance or Islamic financial principles existed at the time of Prophet Muhammad sallallahu alaihi wasallam, when Islam started, and even some financial principles existed before Islam itself. As we say in the Arabian Peninsula, Arab before Islam, they used to do different types of transactions and dealing, gambling, usury, riba. For example, some financial transactions like mudaraba, which is a financial transaction that the Prophet ﷺ himself did before the message of Islam is revealed to him. We know all the story when basically Khadija, who then became his wife, asked him to go on a business trip to basically invest her capital or her money. And that was on the basis of mudaraba, where he went to Sham, Damascus, traded, and then he shared the profit with her. And when she was told about his honesty and in terms of dealing and trustworthiness, she asked him for marriage, and we know this story. However, when Islam came, Islam looked into those different financial transactions. What is basically considered under Sharia or in Islam is bad and not acceptable was prohibited, like gambling and interest or riba. Things which promoted basically reward and risk sharing, like mudaraba, was approved and put within the context of Sharia in terms of its conditions, how basically it can be applied under Sharia, and what makes it basically invalid or not acceptable under Sharia. After the time of Prophet Muhammad ﷺ, because we have the Sunnah, we have the different basically hadith and things that the Prophet ﷺ did, the scholars, basically the age of Tabi'in and Tabi'in, they collected all this information, which then known to be or to be called as fiqh. And they put the rules, the conditions for each financial transactions, how it can be done within basically the boundaries of Sharia. This lasted until the recent history, where during the basically around pretty much 14 centuries, the dealing with these principles was very basic, because at that time we didn't have this complexity in terms of commercial dealings, different financial transactions, banks offering complex products and sophisticated financial products. Then we know that basically the collapse of the Islamic State around 1924 and before, around the First World War, most of the Muslim countries became colonized by different Western powers. And at that time, due to the dealing with financial transactions, the interest-based financial system was introduced to those countries to deal with, as basically they were subjected to those Western powers. This lasted for around nearly 50 years or so, until the Second World War, when those countries started to take their own independence under the United Nations Convention. Then the Islamic jurists and basically Muslim intellectuals, they started to think, why don't we go back to our own tradition or religion, our Islamic finance system? And the first attempt was in Egypt in the early 1960s. Then more attempts started with the Dubai Islamic Bank, Islamic Development Bank, and other banks started basically. From that time, Islamic finance principles were basically or have been started to be presented within a banking institution. How basically those principles are interpreted and applied to be introduced to the public or to the Muslim community as financial products provided by financial institutions. This basically necessitated that those Islamic financial institutions have to be regulated. And then basically started sub-institutions or regulatory institutions like AUFI, which is the Accounting and Auditing Organization for Islamic Financial Institutions, and Islamic Financial Services Board emerged at that time in order to provide this framework for regulating Islamic financial institutions. So, what makes Islamic banking and Islamic financial institutions different from conventional banks? There are four key issues or key things. The structure or the governance of the bank in terms of the Sharia compliance governance. As we see, Islamic banks have a Sharia supervisory committee. This committee is an independent committee. They don't report to anyone in the bank or to the board. It's not a board committee. In order to supervise and oversee all the bank's operation and approve its products, services, and different financial transactions to ensure that they are fully compliant with Sharia. Supporting this committee is a Sharia compliance department in the bank who basically monitors the banks on day-to-day basis in terms of its operations and reports back to the Sharia Supervisory Committee. This department that doesn't report to anybody in the bank in order to ensure the independence and the credibility of their work. And you probably heard about the problems and some scandals that the Co-op Bank faced around a year or over a year ago. Recently, or a while ago, they announced that they are establishing a basically ethics committee, which is obviously taken from the concept of the Sharia Supervisory Committee in Islamic banking. Although they say they are basically ethical bank, so why do they need ethics committee in this case? But in order to basically to emphasize the ethical aspect that they are operating within, which is good. I mean, for us, it's something good that other banks started taking aspects from the Islamic finance and Islamic banking structure and governance in order to reduce the unethical practices within bankers in those institutions. So we'll briefly touch on some Islamic finance principles that the bank use. There are more principles than those, but just in order to basically to manage the time, we just focus on some of those principles. Briefly, there is Mudaraba, which I explained earlier. It's a partnership agreement, profit sharing agreement between the bank and the customers. Musharaka, partnership agreement where basically two parties provide capital and share the risk and the reward, the profit. Murabaha is a credit sale agreement. Ijara, the lease financing. Wakala, an agency agreement, and qard, which is loan without any benefit. The key principles of the Mudaraba transaction, or a product provided by Islamic bank based on the Mudaraba principle, is basically the customers will deposit their money with the bank on the basis of Mudaraba, where the bank will act as a fund manager or as a trustee to invest the money, and the profit generated from investing the customer's deposit is shared with the customers based on an agreed profit sharing ratio in advance. And this is one of the key differences between Islamic and conventional banks. In savings account, conventional banks will provide fixed rate of interest to customers, and they will pay this guaranteed rate of interest. Islamic banks, they don't offer fixed rate of profit or guaranteed rate of profit. What they do, they use their expertise to invest the customer's deposit in Sharia compliant investments and different financial transactions. The profit generated then is split between the bank and the customer based on the agreed profit sharing ratio, which could be 50-50, 60-40, 70-30, depends on the product itself. Therefore, the Islamic banks usually, they give a target profit rate, and on different or various occasions, Arayan Bank paid its customers on the savings account higher than the target profit rate because the profit generated was higher, and the split of profit is based on this profit sharing ratio, not a fixed rate of return. So basically, customers will benefit in this case because they might get higher profit rate than was expected for them to generate on their investments. The other Islamic finance principle that is used to offer savings account in Islamic banks is the Wakala principle, which is an agency agreement that is based on a relationship between the bank and the customer. The bank will act as the customer agent to provide an expected profit rate for the customer's investment. The bank then would invest the customer deposit in different types of Sharia-compliant investments to generate the expected profit. The difference between this principle and the previous principle, the Mudaraba principle, is this principle isn't a profit-sharing principle. It is an agency principle. The bank will take a fixed fee for its basically work and services in terms of providing the expected profit rate. So if you see in terms of the structure, it works pretty much in the same way. However, there is no profit sharing in this agreement. Musharaka usually is partnership between two parties, and in general is used as a financing principle in Islamic finance. However, the use of musharaka is very limited because of the inherent risks associated with the musharaka principle. There are different types of musharaka, but we will not discuss those. We'll just focus on one type of the musharaka after this slide, which is the diminishing musharaka, reduced partnership. Ijara simply, it's a lease agreement. There are certain conditions for the lease agreement in Islamic finance in terms of the conditions of the property, the responsibility of the lessee and the lessor, and in terms of maintaining the property, and basically the right and obligations for each one of them. The musharaka principle is used basically in home finance in Al Rayyan Bank as in terms of type called a diminishing musharaka agreement, which is type of different musharaka forms between the Islamic bank and the customer. Initially, I'll go to that diagram, maybe it's easier to see how it works. The customer and the bank will enter into joint partnership in order to basically purchase the property that is chosen by the customer in the normal way. After purchasing the property, let's say property worth 100,000, the customer contribution, which is known as the customer deposit, is 20%, which represents 20,000. And the bank's contribution is 80%. That's the finance contribution from the bank, which is 80,000. Then to enable the customer to use the property, which is shared between the banks and the customer, the bank will enter with the customer into a lease agreement to lease its share in the property, which is the 80%. So the customer will be paying one monthly payment that consists of two elements: the lease or the rent that the customer pays for using the bank's share in the property, and an element called acquisition element that's related to the diminishing musharaka agreement, where the bank sells its share in the property over the finance term. This could be 25 years, 30 years. So with time, we can see the bank's share in the property is decreasing and the customer's share in the property is increasing. So they started with 80%, 20%. Then over time, it will be 70-30, 40-60, 50-50, 40-60, until at the end of the term, the customer will acquire the whole of the bank's share in the property and will own the property outright. So what makes it different from the standard mortgage contract provided by conventional banks? Basically, the mortgage is based on the banks lending money, charging to the customer to buy their home, and charging them interest over this money. So there is no commodity, there is no asset, there is no trade or investment in that process. It's just money is used as basically as a commodity itself, which is prohibited in Islam or in Sharia. Money can be used in Sharia as a means of exchange only, as a medium between the buyer and the seller. between the parties to the agreement. So in this case, there is property, which is the assets, and the customer and the bank are partners in it. The banks make its profit from leasing its share in the property to the customer. And eventually, the customer will benefit from gradually buying the bank's share in the property. The card principle usually used in Islamic banks or Islamic financial institutions to provide the current account, or that's the principle that the current account is based on, where, in this case, the customer will lend the bank their money without expecting any mutual benefit between the customer and the bank. It's just the bank is entrusted with the customer's money under the card principle. The customer doesn't get any profit or any element of return in line with the principle itself. And the bank makes the money available whenever the customer wants to withdraw this money, whether through internet banking, basically through the debit card, purchasing different items using the debit cards, or withdrawing money via ATM machines. So, as we said, there are key differences between Islamic banks and conventional banks. Just to summarize those differences, the first element is basically the risk element. In Islamic banks, any financial transaction is based on sharing the risk and the reward in that transaction. In conventional banks, they use risk shifting. How they shift the risk? You can see they shift it to the customer in terms of any, let's say, in the mortgage agreement. They shift the risk to the customer. You will see the legal terms and conditions heavily, basically put towards everything in terms of legal obligation on the customer side, in order for them to be to some extent risk-free in that agreement. In the home finance, the Islamic home finance, the bank is a partner with the customer in the property, responsible for the property in the same way. And the terms and conditions are drafted to reflect this fact and to ensure the customer isn't disadvantaged at all. So if basically the conventional banks, we said they shift the risk to the customer, and also they shift the risk in a way of insurance. They insure their portfolio, so for them, some of the risk shifted to the customers, some shifted to the insurance companies, and that will reduce their risk a lot. But that didn't work, did it, in 2008 when the financial crisis basically came? Because, and this is very important, there wasn't any asset backing the agreement between the customer and the bank in the same way like Islamic banks basically operate. And that's why Islamic banks weren't affected by the financial crisis in the same way conventional banks did. Because all their transactions, whether on the savings account, investments, or finance, in terms of home finance, commercial finance, is based on underlying assets. Each transaction is backed by an asset. The other element is the supervisory committee, the Sharia supervisory committee. As we said, in terms of the governance structure, Islamic banks